Hey everyone, and welcome. Today, we're going to break down one of the most important numbers you'll see in any financial report, earnings per share, or EPS. We're going to use the International Accounting Standard, IAS 33, as our guide to really understand how this number gets calculated and, more importantly, what it's actually telling us about a company. So let's start with a really simple but powerful question. If you own a share of a company, you're a part owner, right? So when that company turns a profit, how much of that profit really belongs to your one single share? Answering that question is pretty much the whole reason EPS was invented.
All right, here's our roadmap. We're going to start with that key question, get a handle on basic EPS. Then dig into how it's calculated. After that, we'll get into the what-if scenario with diluted EPS, talk about what makes shares dilutive, and finally, wrap up with why you always see both of these numbers sitting side by side.
Okay, first up, basic EPS. You can think of this as the simple, straightforward, here and now answer to our question. No complex scenarios, just the facts as they stand today. I mean, on the surface, the formula couldn't be simpler, right? It's just profit divided by shares. But as you probably know, that's where the simplicity ends. The devil is in the details. And IAS 33 is very specific about what we count as profit and what we count as shares. And that's where it gets really interesting. So let's peel back that first layer. To make sure investors can actually compare one company to another, IAS 33 lays out some really strict rules. It gives us precise definitions for both the top and bottom of that fraction, all to make sure we're comparing apples to apples. First, let's look at the numerator, the profit part. Now, we don't just grab the company's total bottom line profit. No. For EPS, we need the profit that belongs specifically to the ordinary shareholders. This means we have to take the profit and subtract any dividends that are owed to preferred shareholders first. It's about finding the pool of money that truly belongs to the common stockholders.
And what about the denominator, the shares part? Well, we can't just use the number of shares that exist at the end of the year. That wouldn't be fair because that number might have changed a lot. So IAS 33 says we have to use a weighted average. This just gives a much more accurate picture by accounting for any new shares the company issued or any shares it bought back during the year. And importantly, when those changes happened.
All right, so we've got a handle on basic EPS. It's the reality on the ground today. But now it's time for the plot twist. What if the total number of shares could actually increase in the future? This is where our second number, diluted EPS, steps onto the stage. It answers that critical what-if question. So what could possibly cause the share count to go up? Well, we're talking about things called potential ordinary shares. Think of stuff like convertible bonds that holders can swap for stock, or stock options given to employees. It could even be shares that the company has promised to issue if it hits certain performance goals.
And this right here is the absolute key difference. Basic EPS is all about the here and now. It's based only on shares that actually exist today. Diluted EPS, on the other hand, is the what-if. It's a more cautious look that assumes all those potential shares suddenly become real. It's reality versus a potential future.
So how does this actually play out? Let's use the old pizza analogy. Imagine the company's profit is one giant pizza. Basic EPS tells you how big your slice is based on everyone who's at the table right now. Diluted EPS asks a simple question. What happens to your slice if a bunch of other people who have an invitation decide to show up? And that brings us to the formal definition of dilution. It's simply a reduction in earnings per share. It happens because we assume all those potential shares are converted. You've got more shares, but the same amount of profit pizza. So naturally, everyone's slice gets a little bit smaller.
Okay, let's put some numbers to this. Let's say a company reports a basic EPS of $2.50. That's your slice to the pie today. Pretty straightforward. But hang on. What if that same company also has 1 million stock options out there held by employees? And let's say those options are in the money, which is just a fancy way of saying it would be profitable for the employees to use them. We have to assume they will use them, so what happens to your slice now?
Well, the company's diluted EPS would drop. Maybe it's now $2.25. That number shows the potential impact of all those promises the company made. It's the worst-case scenario for your share of the profits if all those options become real shares, diluting the value for everybody.
Now here's a super important point. We only account for these potential shares if they are dilutive, if they make the EPS number go down.
If, for some weird reason, converting them would actually make EPS go up, that's called anti-dilution, IAS 33 tells us to just ignore them. The whole point here is to show investors the maximum potential downside, not some fantasy upside.
And this brings us to the final piece of the puzzle. Why on earth do companies have to report both of these numbers? Well, it's because the difference between them, that little gap, tells a really, really important story. It all comes back to the main goal of IAS 33, which is to improve comparisons. By making every company play by the exact same rules when they calculate basic and diluted EPS, investors like you and me can make much better, more informed apples-to-apples comparisons.
So, next time you're looking at a company's financials, pay close attention to that gap between basic and diluted EPS. It's a signal. A tiny gap, not many potential shares floating around. But a big gap, that's a huge heads up that the company's made a lot of promises that could create a flood of new shares down the road, potentially watering down your stake.
So I'll leave you with this to think about. When you see a company's financials and you spot that gap between basic and diluted EPS, don't just see two numbers. Ask yourself, what story is this gap telling me? What kind of promises has this company made about its future? And what could that mean for me as an owner?